Welcome back to Real Estate 101. I'm your host, Joe Tercera. And today we're going to continue our discussion on financial planning and talk a little bit about some mortgage elimination strategies. And I'm pleased to be joined once again by Jeffrey Gregory of Desjardins Financial. Jeff, welcome back to the show.
Thanks for having me again, Joe.
So Jeff, let's talk a little bit about some strategies. Let's say someone just got a mortgage or just refinanced. What are some things they can do to speed up the payment of their mortgage?
There's three that I usually like to recommend to people right off the bat. One, instead of doing a monthly payment, do a bi-weekly payment. In a year, there are 12 months in a year. There's 52 weeks, though. So when you divide that by 2, it's 26, which really makes it 13. You're getting one extra monthly payment by doing it bi-weekly. The amount will actually be the same. You know, if it was 1,000, you do 500 every 2 weeks. And most people get paid bi-weekly, too, so it's a lot easier.
Right.
So when you do it bi-weekly, you're always getting one extra payment, which typically will mean you shorten down your mortgage by about 3 years. A second trick I suggest that everyone look at doing is rounding up your number to a whole number. If your mortgage payment bi-weekly is $563, make it $600. When you make that a whole number, one, it's easier to budget and always easier to remember. And two, you actually get more down payment. You actually get more into the principal.
The principal, yeah.
Which, when you look at it, if it's $40 a payment, it's $80 a month. That's $1,000 a year. You don't even realize you're putting onto the mortgage.
Right.
So a little bit simpler. And the third one is negotiate. Don't be afraid to negotiate with the lender. Don't be happy you just got a mortgage. They want your business. So don't be afraid to haggle it a little, because every little percentage point could mean thousands upon thousands of dollars over a 25-year amortization.
That's right.
So those three are very key.
All right. So let's say someone comes into some money. Should they pay their mortgage down?
You can. I'm not against people putting their money into their mortgage to eliminate their debt and improve cash flow. But what they shouldn't do is sacrifice other things. Make sure you have an emergency fund. Make sure you have some money put away just in case something comes up. Once you make that payment into the mortgage, it's locked in your walls. You can't access it. So what happens if you do need to access it for an emergency, the institutions will charge you more interest than what the mortgage is. So talk to somebody about some of the best strategies to look at doing to ensure that it doesn't just.
So what are your feelings about RRSPs versus mortgage paydown?
I like them both. It depends on the individual sometimes. Some people don't like debt, some people want to pay down the mortgage. There isn't one right or wrong. Typically the plan should encompass whatever the best feeling is for the person. My recommendation is do both. You can actually do your RSPs, get your tax refund, and take the tax refund against the mortgage. So this way you can accomplish both goals. A lot of people tend to forget to do one or the other. If you do both, then you actually will have both a happy retirement and less of a mortgage.
All right. Okay, so what about the down payment? Does that play a role in eliminating your mortgage?
It plays a huge part to eliminating the mortgage. The more you can put into it, the better off you'll be. So if you are a first-time home buyer, maximize that $25,000 each person can do. Maximize it if it's a husband and wife or spouse or common law. Each person can put $50,000 into the mortgage. It's less debt. But I caution you on one thing. When you do the first-time home buyer, you can use it for anything. It doesn't mean it has to go towards down payment.
Right.
So don't go and start charging up the visas and so forth for the furniture in the bedroom suite and all that stuff. Now it's become counterproductive. Instead of getting a 4% mortgage, now you got a 17% credit.
Right.
Sometimes use some of that money to get all of those, and then you also have the mortgage. Maybe it'll be a little bit higher, but you don't have the higher debt stuff. So again, some good sound advice can be very, very helpful in the long run with that.
All right. So what about investment income? Let's say you have some investment income. Mm-hmm. Can you use that?
You certainly can. Utilizing low interest, maybe people have GICs that aren't doing anything, then yeah, maybe putting it against your mortgage is a good way to increase your cash flow. What you have to make sure is that's not part of your emergency fund. If something happens, you don't want to lock it away. And you got to be careful of taxes. Sometimes when you go to sell one to eliminate another, Revenue Canada sits there and goes, thank you for not knowing the rules. So do make sure you do get some proper advice with that. But yeah, it can be an effective way to eliminate more of the debt.
All right. So a lot of financial planners, talk about borrowing to invest. Mm-hmm. Do you think it's a good idea to use your mortgage or your house to do that?
You can. I think a company such as Manulife One. They've been out there in the news and so forth, and it's a really effective strategy. You put all your debts into one, all your income goes into something, and HELOC mortgages, lines of credit. A lot of people use that. My suggestion is if you are a disciplined person, then you're okay with it. If you are not a disciplined person and you don't know if you're a disciplined person, then come talk to anyone that has the letter C after their name, a chartered accountant,
Right.
a certified financial planner. They can help distinguish that with you. It could become a very dangerous tool as well, and the government's conscious of this. They're worried about people's debt levels and so forth. So it can be good. It can be really effective in eliminating your debt very quickly, but discipline is the whole key to success and can help with that where need be. So not against it, but be very, very cautious about using it.
All right. So for today's final question, any last tips or suggestions?
Yeah, actually, there's one that people, I hear a lot of people trying to do and get interested in. It's about rentals. They like renting out a piece of their house.
Right.
They want to rent out their basement and so forth. Can be a very effective strategy. Create some good tax refunds.
Cash flow.
Cash flow. But again, caution with this, because if you use that against your mortgage, et cetera, et cetera. But you got to be careful because now you have landlord issues.
Yeah.
And I'm a financial guy. I'm not necessarily going to be the lawyer at this point, but you have to make sure you know all the rules. Make sure you deal with an accountant when you deal with this. Make sure you do the rules right. Make sure you're writing off the right parts. Make sure you know your landlord act. So that could be a very, very effective way of eliminating the mortgage as well due to increased cash flow.
Right.
But
Goes without saying, it comes with.
Yeah, there is a lot more to it than meets the eye. So getting the advice from family and friends can become very expensive if you don't actually get proper professional advice when dealing with something like that. But it's another great way to eliminate a mortgage.
All right, Jeff, thanks for coming on today's show.
Appreciate it, Joe. Thanks again.
If anybody has any more questions or needs the service of a top financial planner, they can get in contact with Jeffrey Gregory at Desjardins Financial. I'm your host, Joe Tercera. Thanks for watching, and we'll see you next time.